Good afternoon, and welcome to this special edition of the Daily Energy Markets Podcast. It is Friday, November 8th, 4 p.m. UAE time, 12 noon London, where Christoph is, I believe, and 8 p.m. in the evening, where Mike Muller is. And we thank them both for giving us some time before this week ends. Let's kick off with Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy at Columbia University. Christoph, there's been so much drama this week, but we're exactly where we started from the oil price point of view, as it's some kind of a reference to what this big drama week means. How do you read that? Is it still digesting this big news of Donald Trump's re-election as president, or has it digested it and said, well, nothing to worry about here, nothing's changed? Your thoughts on the big news this week and its intersection with the energy markets?
On the big news this week, these are two very separate questions. On the intersection with the oil price in particular, I think it is a bit of a wait and see attitude at the moment. Everybody knows that Trump is trying to unlock domestic energy production, including oil production, in particular shale oil production, and drilling in the natural preserves in the federal land where it is currently not possible. Everybody also knows that A, this is a long-term prospect, and B, he has good friends in the oil industry, so it doesn't necessarily mean to do everything immediately to get prices really steep down. Everybody also knows that this presidency is likely to mean an increase in geopolitical assertiveness of the US. And I don't mean what people often mean here, that just the tariff wars and all of that, which may slow down global growth. But much more concrete, Trump is a very good friend of the state of Israel and his leading politicians, those in power currently, and is much more likely to support Israel in an escalation versus Iran. And that may, in the short term, lead to a firming up of the oil price as the risk premium goes up. So these are the two tensions, one long-term and one short-term. The long-term one a bit more vague than the short-term one. And I think that's what the oil price is doing here, treading water. What is probably more interesting in the medium term is what the impacts on demand will be. And for that, you have to have a longer view term look at the relationship between the US and China and the possibility of trade wars. And again, I think it's a bit too early. People will see what are the tariffs he implements. Is there a difference is it possible legal to have a difference between tariffs for imports from China versus the rest of the world? What is China going to do? Are they going to boost their economy now in response, increasing oil demand in due course? So these are things we can discuss, but right
I suppose
now,
there's so many questions there. Let's go to Mike Muller, head of Vitol in Asia. Mike, $75 Brent sort of stuck there, give or take a few cents each day. But ultimately, is this news of the week essentially another piece of just geopolitical risk factors that you put in the geopolitical risk bucket? And we've sort of coming to an end of the year when, despite all the noise of the backdrop of conflict in Europe and the Middle East and so forth, and a few brief moments where the oil markets have spiked on geopolitical tensions, ultimately the market is unperturbed by geopolitical risks. Your thoughts on this decision, on this news this week and its intersection with the oil markets?
Yes, John, I guess it's fair to say that a lot of the geopolitical tensions have posed a risk to energy supply infrastructure, but then what's actually borne out is that energy supply infrastructure was unaffected. The major disruption we continue to have is the threat of attacks on passages in the Red Sea, the Bab el-Mandab. And other than that, there was some concern about gas-producing infrastructure in the southeast corner of the Mediterranean, close to Israel and Gaza. But it was quite telling when the Israeli strikes occurred that no energy infrastructure was targeted. And as a result, that calmed the market very, very quickly. And what we call the cold skew, the upside protection the market was paying big insurance premium for in options markets, very quickly went away. Of course, we now have the prospect of yet further retaliatory strikes, and that is still priced into the market, I think, sitting here at just shy of $75, and of course it's been closer to 80. So we're at a price level that does not necessarily reflect what I would say is a consensus view that next year, all things being equal, and there being no disruptions and no geopolitical impairment of energy production, there is the risk of a build in inventories, which will pressure the oil price. So the question then is, how much of the current price is geopolitical risk premium? The debate is out on that. I think it's also fair to say that there's been much more movement in markets other than energy, other than oil, as a result of the US election. And then the other thing that has been on in the headlines this week is, of course, the meeting of the high-level plenary in China to give yet more stimulus to the Chinese economy. And there also the impact on markets has been plus minus 1% on various indices. So, the market
in that
is
sort of regard, it's kind of like everything has continued as was. We were already hitting records in the equity markets every few days pre this election result. We were kind of a stagnant oil price, sort of agnostic to geopolitical risk, and that trend lines have continued. Christoph, let's look a little bit at this from a Europe perspective. You're sitting in London, you are from Germany, and you've worked in Russia. So I'm going to connect all those dots somehow, because on the same day that Donald Trump was elected, the German government collapsed. I'm not sure if those two things were correlated, but they certainly felt like it psychologically. Your thoughts on the ramifications for Europe? The general narrative perceived is that Trump will do some deal with Putin to sort of compel Europe and the Ukrainians to settle. Your thoughts on how all that plays out and what it could mean for the energy markets?
Yeah, I was about to refer to Russia in the context of what Mike said about the energy markets. There are some things which have changed, and one is certainly that this was a sweeping victory, so Trump will have his way much faster, much more decisively, in addition to being better prepared and having people in place. So whatever happens will happen very fast. One of the unknowns which will be important for Europe and the world and energy markets is the dealing with Russia and Ukraine. And when you listen to the first noises from Zelensky and also from Putin, they are expecting to be all expecting probably to be the first piece of the new puzzle Trump is going to put into place. That has the potential, any kind of negotiated settlement there has the potential to free up Russian oil and commodity exports again. They have always taken place, as we all know, but there is a risk premium, there's higher transaction costs that need to be, and they would disappear. And in exchange, you probably see sanctions reimposed on Iran, which would have the opposite effect. So these two things may balance. In Europe, it looks like the Germans have immediately thrown the towel when they got the news of these elections. This does not look very good, or maybe for some people it looks good, but the coalition there is broken, as far as I understand, and the current arguments are around when the new election takes place, not whether it takes place. And this may well lead to yet another European core country shifting decisively to the right. With the exception of the UK, we have seen this in France, and we will see this in Germany potentially in two different ways. One is that there's a very high percentage of the electorate willing to vote right-wing parties, real strong right-wing parties, like this German group, which is called AfD. And the second is that also the mainstream coalition, and will have to be a coalition because every big old party is too small now, is probably unthinkable without the conservatives, Merkel's old party, who have been now watching, were not part of the current coalition. And the Social Democrats and also the Greens and the Liberals who have formed the current coalition are probably shrinking a lot. So a general shift to the right, both in terms of the violent underlying sentiment of the street, so to speak, but also in terms of policy.
And on that point, Christoph,
and with Italy, and then you have a Europe which will be much more likely to work with Trump.
Work with Trump. That was my follow-up question, that this sort of emerging right, and if we get Le Pen in France as well in the next election, presidential election, which is, I think, 26, that this group will not resist Trump's kind of unilateral settlement of the Russian-Ukraine conflict. Would that be your reading on it?
they're less likely to resent it than those parties on the left. Although the mixed picture is really blurred because you have Russian friends and Russian enemies and seemingly cutting across the across. But what right-wing governments generally do is they put a higher premium on economic policy and in getting the financial flows right. And for that, you need Russia. You cannot just ignore, this giant, the biggest exporter of all commodities on the planet. And Trump certainly is coming from that economic viewpoint that you reward strength and that this is playing to your advantage. And most of the European centrist or rightist parties would follow suit there.
Mike, this week obviously kicked off with OPEC Plus deciding to postpone their increases from, again, they had originally postponed from October 1st to December 1st. And then this Monday passed, they increased, or they had extended to January 1st. That's really what moved the oil market this week in the earlier days of the week when it sort of came up from the low 70s to the mid 70s and is kind of held there, propped up by that, it would appear originally. Your thoughts on where this all lands with supply and with OPEC Plus decision making?
Yes, that's a pretty clear one. Indeed, there was a lot of talk of it happening as a possibility before the weekend. And then on Monday this week, it came as a confirmation. Now, there's a huge range of estimates of how much production was actually going to come onto the market incrementally. The actual number, of course, the headline number is quite substantial, and therefore it came as a tonic to the market that was worried about oversupply, that that OPEC Plus wouldn't be pushing this extra volume into what looked like a fragile market in December. And I think it was good for $2 a barrel in the early part of the week. Something very strange happened though, because normally what you get is a war risk premium, or let's be more specific, a risk of infrastructure damage premium coming into the market in the shape of options call skew. People wanting to buy call options more than people wanting to sell them. And the call skew went up on Monday as well. And that normally only happens on Fridays when there's a big long weekend. And it has been a historical fact that the protagonists have chosen to lob missiles at one another at weekends when markets are closed. So that was unusual, and therefore had some people suggesting that there was a view that there was a higher risk of retaliatory efforts or indeed a follow-on strike from the Israelis. And that was also cooking the market from the low 70s to the mid to high 70s. As far as supply demand fundamentals are concerned, the overriding picture is that OPEC Plus will continue to be challenged next year because the projections for demand have been edging down, largely on concerns around China. That's balanced, of course, by the fact that global inventories of products, and inventories in China in particular, are quite low. So there's been a destocking effort going on. And as a result, we've had a period of stock draw, which is got to be seen hand in hand with a pretty certain outlook for 2025, where we will see a stock build. So the world doesn't really have a call on incremental OPEC plus production if the numbers are roughly as follows. Non-OPEC production coming into the market largely from the Atlantic Basin at about 900,000 barrels a day incrementally next year. And demand for products in total maybe a shade over 1 million barrels a day. But of that, a good 300 or so is NGLs. In other words, demand for refined products made from crude oil, such as OPEC plus crude, is roughly the same as the supply from non-OPEC sources. And as such, there is, on paper, little room for OPEC plus to increase production unless demand looks a lot rosier. And with demand projections having been revised downwards incrementally this year, not just because of China, that it was a concern to markets to see OPEC Plus setting about with intent to put more production into the market. The one thing that is needed, and this also applies to gas markets, is a cold winter to give a little bit of a tailwind to those bulls that wish to see prices
Which we're not getting yet, right? It seems the winter's warm so far.
But since markets price everything in that we know, I don't think too many people are unhappy with today's price.
Just, Mike, a quick follow-up on that. The other thing that happened after the decision by OPEC Plus to postpone their increase, we had the Saudi OSPs, which came in at a discount into Asia. I just wanted to get your thoughts on that.
I mean, very often people read a lot into those in terms of whether the Saudis wish to see people happily nominate more because they think the OSP is reasonably priced. But the pattern for much of the last 2 years has been one that totally gels and makes sense, with the Saudis being the swing producer and essentially being the major factor behind OPEC Plus, helping support prices by keeping volume off the market. So Saudi have been able, via their policy and their OSPs, to set the OSP at levels that most refiners complain about. and that is quite purposely done because there's less Saudi in the market than there could be, right? I don't think this last round of OSPs gave me any cause for concern or surprised in any particular way.
Christoph, one of the things that OPEC Plus can't really postpone, and I welcome your views on this. I mean, they postponed the 8 countries that are making these extra 2.2 million barrel a day cuts. That's been postponed now from October 1st to December 1st, and now to January 1st. And what kicks off in January 1st, Christoph, is the UAE's increased quota. They have solicited and secured the right to produce more oil within their quota. Your thoughts on that being postponed in this sort of postponed sort of framework, or what is your view on the UAE moving forward with that?
I think there is a fault line waiting to be addressed again, and it has been for a number of years. I am not sure I think it's still true that in percentage terms, the UAE is actually having the largest cuts of all the major producers, measured by their new total capacity. And they are keen, of course, to fix that in the short term. They also have announced further increases in their capacity. I think what looms there in the background are two very tricky questions for OPEC and OPEC Plus. One is sort of medium term, which is what we are observing now, this constant postponement of rolling back the promised cuts, and so just in a way just leads deeper into a corner from where it seems to be very hard to escape because as Mike has shared his view, and that we have in the fourth quarter 24 and through the year 25 most likely an excess supply situation. So the longer you postpone the reckoning, the heavier the price decline will follow once it happens. Plus, you have still a discipline problem with countries like Iraq and so on, which hasn't been solved. That's the medium-term political problem, which I don't see being addressed, nor would I know how to exactly rectify it. Then there is a long-term problem here, for which this one is in a way a harbinger of things to come. And the long-term problem is, if we do have peak oil, or if oil demand is plateauing, and we have said this many times here, then we will enter a world in which the low-cost producer is king, and in which you have severe price competition potentially, because everybody who wants to just, in a shrinking market, who wants to keep his export volumes in absolute terms constant, needs to increase his market share by definition. Market goes down, the same 10 barrels you sell are a larger market share than before. And how do you do that? You undercut the price of your neighbor, and that will put low-cost producers in an advantageous position volume-wise, but the market as a whole looks like coming under severe price pressure, and it will be very hard for any kind of organization which tries to negotiate a price for the market, let's call it that way. It will be very hard to do that. And that is, I think, the deeper reasoning why we are seeing the UAE and others to expand capacity. They're preparing for that point in time. Now, OPEC's research department says, oh, that's not going to come before 2040. The number of voices who joined the chorus saying it's likely to be this decade is increasing, and I think for very good reasons. So I think it's very likely that before 2030, that for once the IEA has it right here, that before 2030 we see not a peak in the sense of a very steep fall, but at least a plateau, and then price pressure on the oil market and pressure on OPEC Plus as an organization, which will be of the same nature of what we have right now, but just much more severe.
Mike, one of the big stories that came out of ADIPEC, where I've been all week, was all things data centers and the intersection with nuclear power. It was the headline of the ADNOC CEO's opening address of the week at ADIPEC, and this unexpected surge in demand for power to feed AI data centers and the rehabilitation, which we've already seen in the last month or two, or recent months, the rehabilitation of some nuclear power plants in the United States, taken on by, I think, was it Facebook or Microsoft, or individual companies basically taking on individual nuclear power plants. I wanted to get your thoughts on that, just this sort of demand surge from the data, AI, nuclear, and how that might play out as we go forward into some energy policy making. Your thoughts on all of that, Mike?
Well, Sean, I follow your social media posts, and you
Yeah.
also tweeted or posted that an average AI chat GPT search consumes 10 times more power than a conventional Google search on the same matter, right?
Yeah.
So it's something that the industry's been following for some time now, which is the demand for power for these search processes and what that means in terms of extra data centers. And of course, data centers need to be located optimally, both in terms of where there's demand for them, but also where energy is not just affordable, but reliably so. And in many cases, there has been talk of some of the major consumers of data center hardware considering small-scale nuclear side by side. More conventionally, over the past few years, we've been looking at wind farms and solar farms co-located with data centers and indeed batteries. So that has been the typical constellation. So this is quite a new concept to have lots of small-scale nuclear facilities powering these large data centers. That was more of a US thing. I saw Dr. Sultan Al Jaber's speech, but I wasn't at ADIPEC myself. So yes, I can relate to it. And the real question is, where do we go with the energy mix? There are obviously some parts of the world that are less happy with nuclear. And we still have a major intermittency challenge in terms of the transmission capacity, the grid capacity to cope with the intermittency challenges from, in some cases, alarmingly fast build out of renewables.
Do you think there could be appetite in Japan to bring back some of their nuclear power plants that were retired in the aftermath of Fukushima?
That is quite a loaded question, Sean. Yes,
Yeah,
there
I
is
know.
capacity. There's
I
capacity
mean, I would say the
in
same
Japan
to
that is.
Christoph about Germany, because
Look,
they've also.
the key here is what Mike just mentioned, is this intermittency problem. We have this giant rollout of green energy, which to 95% is investment going into power generation. And there, the overwhelming part is wind and solar with an intermittency problem. And what is happening is that both on the technological side with nuclear energy, we see more flexibility to provide backup generation. Traditionally, backup generation to solve the intermittency problem is coal and gas because they can be ramped up and down relatively easily. And nuclear wasn't in that shape. Now, I've been told that remember 22 when we had the invasion of Ukraine and gas prices went through the roof. One of the underlying reasons was also that almost the entire nuclear power fleet in France was undergoing refurbishment and restorations and so. And when that came back, apparently the flexibility of these huge conventional nuclear reactors had tremendously increased, so that now within the space of an hour, they're capable of ratcheting up and down between 10 and 70% of their load factor, much faster, much more flexible than before. And add to that this potential for a new generation of small component reactors, which also are said to be much more flexible. Then indeed you have a role for nuclear to back up renewables, which wasn't present before. And that would certainly be a game changer in those economies which need it most, which are the fast-growing Indias and Chinas and Vietnams.
I bring it up quite at this moment because I think also it's quite relevant to the geopolitical posturing that the US could take with Putin, and obviously Russia being the source of the very critical raw material uranium, and the US being very, very short of these critical minerals that they need to rehabilitate their nuclear capabilities. Mike, looking forward, and the other big story this week that surfaced is the price of money, and the Fed sort of back in the crosshairs of the Powell versus Trump barrage that we had during the Trump presidency. The price of money, and at ADIPEC, I was hosting the ADNOC Trading Forum, and one of the reasons that came onto the stage about perhaps why there was a declining performance of the oil price this year was the fact that the price of money was quite high, and it may now come down. It is coming down. Your thoughts, Mike, on where that impacts the energy markets, the price of money and trading, and the idea to go forward as price of money declines?
Yeah, two things. There's the classic correlation between the dollar strength or weakness and the oil price, and those are inversely correlated. Interestingly, of course, on the election of the Republican of Donald Trump, the dollar went up and so did oil. but it has now stabilized. So I guess that's it's more of a stock market thing. But then the cost of money, I think what you mean is the cost of borrowing, right, and financing projects.
Yeah.
And of course that's seems to have peaked. So the prospects of inflationary worries are perhaps a little bit mitigated, a little bit less than they were before. But it does clearly feature in people's ability to create leveraged IRRs, leveraged returns on projects that become more attractive if your cost of borrowing for a medium risk country is maybe 7, 8, 9%. And that definitely eats away at the capacity of the market to bring to market fresh FIDs on projects. Now, if you're talking about traditional, relatively low-cost provinces such as deepwater Gulf of Mexico, USA, or maybe in the gas case, offshore Northwest Australia projects, you have a little bit less risk involved. But I think it will weigh on people's economics in a way that it didn't when interest rates were negligible.
What about on the actual trading process? By trading houses, obviously you're in a very big one and has obviously lots of access to capital. But for the industry as a whole, accessing that kind of credit line at those kind of prices, does it impact liquidity?
Well, I would say there's no issue with securing revolving credit lines from the lending institutions to commodity trading.
But being able to afford it is the problem.
Yeah, well, 2021, 22 taught us a few things that many hadn't perhaps realized, which is that the cost of trading is not just interest, but it is also the margining requirements, not just the need to stump up money overnight when exchanges like TTF double in value, but those exchanges look to secure their adequacy by imposing huge initial margins. And that requires trading companies to come up with billions of cash if they're major players in certain commodities, such as LNG in the example I'm citing. So I'd like to think that the industry has derived some learning from that and put in place larger swathes of tranches of cash, which may cost a little bit more to have for such a rainy day or such a volatile outcome. But sure, no, I don't think that a 5% interest rate environment, as opposed to a 3% interest rate environment, has materially impacted people's ability to trade and have credit lines to trade with. It's more of an issue in terms of weighing on marginal projects in sort of traditional low risk infrastructure in energy, where maybe a 9% return was quite okay when the cost of borrowing was 2%, but now it's not okay. Yeah.
Christoph, just picking up on that, of course, we've had that Fed out with their quarter basis point cut, 25 basis point cut this week, and some that I'm not going to resign language by Powell. Your outlook, Christoph, for the monetary policy making, regardless of the political backdrop, is there a pathway here for a more robust cuts, or how do you see the monetary policy playing out?
Well, first of all, I need to sort of, for a second, put on the economist's hat. When you talk about the costs of credit or when you talk about the price of money and so, it's very important to distinguish these nominal variables from real costs and real prices. In other words, an interest rate of 5% is something very different in inflation rate when inflation runs at 7% than when inflation runs at 0. And if you take into account of that, then you get a real interest rate adjusted for inflation. Then we are not in a really high real interest rate environment yet. And that explains why there is considerable leeway either way at the moment. But for the impact going forward, I think this is an interesting thing. Start with a look at what people usually say, why Trump had this sweeping victory. Then they say because people voted for an agenda, not despite the person, so to speak. And the agenda was immigration, economics, and for lack of a better word, geopolitics. And most would emphasize the economic part of that. And when they say that, what they really mean and what they say is it was because the American people were tired of inflation and were tired of seeing that in the last few years prices going up by 20% and all of that. That might be true, but the only explanation for this having such a profound effect at a time when wages rose by the same or more is that there's income distribution has been completely out of whack over the last few years. We are back in the 30s for a number of years now, as far as the distribution of income and of wealth in the society is concerned. So there's a
What do you mean the 30s?
In the 1930s.
1930s, okay.
We're having some of the most uneven income distribution in the US right now, which we ever had measured. and with wealth distribution. So that explains why millions sort of voted for a club of billionaires because they got so disappointed from their own democratic representatives, and why inflation has this kind of profound effect because there are too many people at the lower end of the income ladder who really suffered from it. Now, going forward, it seems to me that Trump, by nature, will be an easy money guy. He will need to have money for his expenditures and so on. He will sooner or later run into conflict with a Fed president if this Fed chairman is more conservative. And Trump would not be the first right-wing politician who blows through the budget very quickly. And generating inflation would be the result of some of his proposed, running up of debt and deficits. And that would be potentially having the seed of unsettling him at the next election. So there's a really interesting one to watch, and I don't think that the awareness of those potential consequences of some of the proposed policies which we are seeing now is particularly high in Republican circles, or that he and his advisors really want to hear about that. So that's one to watch. And it starts right now. It's not a matter of inflation going down to zero and then Trump taking office, inflation going back up. It starts right now with the question of whether inflation rates continue to tick down as nicely as they have over the last 6 months.
Mike, last word to you on China. One of the big stories out of China in recent weeks is the stimulus, these announcements to try and stimulate the Chinese economy out of what generally appears to be some element of malaise. Your thoughts on that stimulus so far? Is it working? What does it look like going forward? How committed and how big do you think the Chinese are willing to go, and its impact on China's energy consumption?
Yes, the measures coming out this week have been less profound than the ones that came out a month and a bit ago, which really or 2 months ago, I guess, which really sent the stock market into quite a buying frenzy and had the impact of making the middle classes of China feel a little bit more affluent and spending more. But what's the impact of this week's plenary meeting? I mean, we have various metals like copper, ferrous metals down 1.5–2%. Equity markets are down a little. So it hasn't had quite the same impact. And these measures are really designed, I think, to tackle local debt issues and to contain or counter downside risks to the economy. There has been a tendency to do a bit of GDP window dressing at the end of the year, but they are looking to fix the ailing construction sector. It's the same old, right? So the last set of stimulus measures that sent the stock market soaring didn't do much for energy, but did something for certain industrial measures. One has to think that perhaps they might have held back in light of the political news out of the US also, to have a little bit of running room left in the eventuality that there's talk of tariffs as soon as Trump assumes the presidency, which is what many people are assuming, of course. So yeah, I think there may be more to come. China has been quite important in shaping the mood here in Asia. I think it's fair to say that Asian oil products markets are more bullish than the rest of the world. In fact, they've been surprisingly strong. We've got markets in backwards structure, both in crude and in most products. And whilst the petrochemical feedstocks market is pretty weak, distillate's been impressively strong, as has jet fuel. And part of the reason for that is that China is not exporting as much to the world because of a limitation on export licenses. So how long that continues, I don't know, but it's certainly rescued refining margins from being woeful a month ago to being quite okay now, and giving people pause to say, well, hang on, those run cuts, maybe we try and reverse them. And whenever that happens, of course, people come knocking at OPEC Plus for marginal crude supply, and that helps the sentiment a lot.
Well, we're going to have to wrap it up there. The end of the week in which Donald Trump is re-elected president of the United States. Brent crude oil is trading at a kind of flat line, $75 a barrel, more or less where it started before the election results came out. I suppose a weekend to digest all of this. We've had our sugar high rush in the equity markets of the Trump election. A weekend to digest all the news is probably in order, and a bit of rest, and we'll see where all of this goes on Monday and into November, or into the rest of the run into Christmas and all of that. Mike Muller and Christoph Ruhl, as always, thank you so much for adjusting this week's schedule so that we could have this before the week finished. So really appreciate that. Have a great month, everybody. Look forward to seeing you both in a month's time when we'll know what OPEC Plus has decided to do in 2025. At least that's the expectation. All the best. Thank you, Mike. Thanks, Christoph.